Hey traders, Nick Shaheen here looking at the final chapter in the SPY call calendar lesson. So the idea is to demystify options, and a lot of people shy away from so-called complicated option trades. But in this case, it was a real example that I shared ahead of time, and it played out almost perfectly, so I'm just doing a follow-up video to that. You rarely see a almost perfect execution. How it unfolded. So I saw a bullish pattern forming in the SPY, ignored the news, said, okay, if this breakout happens, the SPY is going to go above 294, but it's going to take a few days. So I wanted to bet bullish at 294, and I put a line on 294, and that's the line right here. So I bought the June contract for 26 cents. For 294, so it expires on Friday of the same week, this week. That costs 26 cents, so not a lot of money, right? But it's still, you know, if I do 10 contracts, that's $260 out of my pocket. So to lower my expense, out of pocket expense, I also sold the same level, 294, the contract that expires on Wednesday, yesterday. Today is Thursday. So the SPY has three contracts actually. One expires on Wednesday and one expires on Friday. So I bought the Friday goal that I wanted at 294, but I thought that it would take some time to get there, and I sold the Wednesday goal of 294. And this is the actual price action that happened, and it died yesterday just before it hit 294. So this was perfect. So what happened here? The maximum out-of-pocket now happened to be, I cut my expenses in half because I paid 26 cents, I collected 13 cents. So the out-of-pocket net debit was 13 cents to open this whole trade. So here's what happened since then. The Wednesday calls died for maximum gains. I collected 13 cents. That money is mine. Whoever bought them lost. So now the calls really only cost me 13 cents. So if I did 10 contracts, the whole thing cost me $130 to open earlier. And then this morning, the contract for the 294 was $2. So for Friday. So $130 turned into $2,000 because this died for maximum gains. That's just on 10 contracts. So the concept of using calendars is pretty handy when you know levels and you can kind of forecast patterns. So if my goal was 294 by Friday, and I thought that there was a window of opportunity where it can get to 294 but not quite by Wednesday, then I can use the SPY contracts to do that. Now they have 3 of them every week, and same for the SPX. But you can't do this with an SPX because it's an index. The ETF, it works, the stocks, it works, but not with SPX or RUT or NDX because they're indices and they are cash settled, so you cannot sell risk against a different time frame. They won't let you do that. You would need a huge account in order to take on selling naked legs inside of an SPX. But for the SPY, this is an easy way to do it. By the way, I could have done this on the puts. So the calendar concept works the same on all of them. So when I have a goal, whatever the stock is, this is Apple. So if I think Apple is going to 215 by August because of earnings or whatever, then I'll buy the 215 August and I'll sell the July 215 against it, therefore cutting my entry cost. I think I shared a video on that too. So if I wanted to short Apple and I think it's going to 180 by August, I'll buy the put for 180 at August and I'll sell the put against it for July or whatever. So it all depends on what my thesis is on a particular ticker. It works the same way. Now these are called calendars because I'm playing with the calendar. There's another way of doing it where it's kind of a calendar, but you vary the levels. So if I buy the 180 put, but I wanted to sell the 177.5 put against it, now it becomes a diagonal because it not only goes this way in time, but it also goes diagonally. Okay, so quick wrap-up lesson on a calendar using the SPY call calendar actual example that worked this week. Nick signing out.